A year ago, you were told the government was about to cut Medicare by 4%, automatically, with no vote required. It did not happen, and almost nobody has told you why. That prediction was correct when it was made. The arithmetic behind it was real, the law that triggered it was real, and the people warning you about it were not making it up. It simply did not arrive, and the reason it did not arrive is the single most useful thing in this entire video. But 4 other things from that same law did arrive, quietly, without headlines, and 3 of them have dates attached that land in January. So this is not another video predicting what a bill might do. That bill is a year old, it is signed, it is law, and enough time has passed that we can check the receipts. Here is what I found when I went back through it, and it is the pattern I want you to carry through the next 27 minutes. The predictions that failed and the predictions that came true split along one line, and it is not a political line. Everything that got canceled had an industry standing behind it. Hospitals, doctors, insurers, organizations with offices in Washington, and people whose job it is to make phone calls. Everything that survived lands on an individual filling out a form at a kitchen table. That is the whole pattern. Not one party protecting its friends. A system that responds to whoever has representation, and a great many of you do not have any. My name is Kevin. I read the boring documents so you do not have to sit with them. Every week I bring one of these here in plain English with the actual move attached. If that is useful to you, subscribe and turn the bell on, because the 3rd item in this video takes effect on the 1st of January, and the failure mode has nothing to do with whether you qualify. So, the Medicare cut. Let me give you the whole story because it is genuinely instructive. When that law passed, it added enormously to the federal deficit, and there is a separate law on the books since 2010 called Statutory Pay-As-You-Go, which says that when Congress increases the deficit, automatic cuts must follow. It runs on its own. Nobody has to vote for the cuts. They simply happen. Social Security is exempt from that process. Medicaid is exempt. Most low-income programs are exempt. Medicare is not. And the reductions to Medicare are capped at 4%. So the arithmetic was straightforward, and the Congressional Budget Office ran it. Roughly $45 billion out of Medicare in the first year, and something in the region of $500 billion across the following decade. That is where the warnings came from. They were not invented and they were not exaggerated. And then in November of last year, during the negotiation that reopened the government, a provision was included that wiped the pay-as-you-go scorecard clean. Not reduced it, erased it, which meant the trigger never fired. The 4% cut that providers had been preparing for did not materialize, and the $500 billion over a decade went with it. Now, I want to be careful and fair here, because there is more than one way to read that. If you are a hospital, a doctor, or somebody on Medicare who would have felt those cuts as fewer accepting physicians and thinner services, this was straightforwardly good news. It is difficult to argue otherwise. If you care about the deficit, this was the 2nd time in recent memory that a scorecard designed to enforce discipline was simply erased rather than met, and the Committee for a Responsible Federal Budget said so plainly at the time. There were offsets available. None were used. Both of those are honest readings. What is not in dispute is the mechanism, and the mechanism is the lesson. The Medicare cut disappeared because the people it would have hit had somebody making the case for them, continuously, in the building where it was decided. And I want to spend a moment on how that provision actually got there, because it explains a great deal about how these things work. It was not a standalone vote. Nobody stood up and proposed protecting Medicare from the sequester as its own bill. There was a bill introduced to do exactly that, and it went nowhere. What happened instead is that the scorecard erasure was included inside the enormous negotiated package that reopened the government after the shutdown. It was one provision among dozens, in a bill that had to pass for entirely unrelated reasons, and it was attached in a moment when nobody was going to vote the whole thing down over it. An amendment was submitted to strip that provision out. It was never scheduled for a vote. So a $500 billion change to Medicare over a decade was made without a single debate on the subject, inside a bill about keeping the lights on. I am not saying that is corrupt. That is how nearly everything of consequence gets done now, by both parties, and it has been that way for a long time. But it is worth understanding, because it is the reason predictions about legislation are so unreliable in either direction. The thing you were warned about can vanish in a paragraph you never heard of, in a bill about something else, at 3 a.m, which is also why the correction never reaches anybody. The warning was a story. The cancellation was a line item. And there is a second thing worth knowing about it, which is that it is not permanent. The scorecard was wiped as of the end of that year. It did not repeal the underlying law. So the same mechanism still exists, still applies to future legislation, and could produce the same threat again the next time a large deficit increasing bill passes. So the correct summary is not that Medicare is safe from this. It is that this particular trigger, from this particular law, was diffused, once, in a negotiation, and the device it was attached to is still sitting there. Velma is 76, and she spent last autumn genuinely frightened. She had watched the coverage, she understood it correctly, which is more than most people manage, and she reached the conclusion that her Medicare was about to be cut, and there was nothing anybody could do because no vote was required. So she did what a sensible, frightened person does. She started delaying things. She put off a procedure she had been advised to have because she wanted to see what her costs looked like in January before committing to anything. The cut never came. She delayed that procedure for 5 months for a reason that had stopped being true in November, and nobody told her, because the announcement that something is not happening is not a story anybody covers. She did not act foolishly. She acted on the best information available, and the correction never reached her. That gap, between the warning that travels and the correction that does not, is exactly why the quiet rules exists. Not clever strategy. A plain, current account of what is actually true right now, in large print, so that nobody delays a procedure or a decision for months on the strength of something that stopped being accurate. The scary version of the news is always louder than the update. It is at kevinexplains.shop. The link is in the description below and in the pinned comment at the top, and if you are watching this on your television, there is a code on the screen you can point your phone camera at. 7-day guarantee, no argument. If it does not put something in your hands you did not already have, send it back. Now the 4 things that did survive, and the first 3 all begin on the same day, the 1st of January. Number 1 is the work requirement for Medicaid. Adults covered through the expansion, meaning people between 19 and 64 who qualify on income, will have to demonstrate 80 hours a month of qualifying activity. That is roughly 20 hours a week, and it can be met by paid work, by half-time schooling or training, by community service, or by combining them. It reaches across 43 states and the District of Columbia and touches roughly 20 million people. Now, before anybody switches off, 2 things. There are real exemptions: caregivers of dependent children, veterans with disabilities, pregnant women, people with serious mental health or substance use conditions. And if you are over 65, you are not in the expansion group at all, so this does not apply to you directly. And on the policy itself, I am not going to tell you what to think. Supporters argue a work or community engagement expectation is reasonable for able-bodied adults and exists in other assistance programs. Opponents point to states already running it and argue the coverage losses come overwhelmingly from paperwork rather than from anybody refusing to work. Both are honest positions held by serious people. What is not a political question is the failure mode, and this is where the pattern from the top of the video comes back. Georgia has been running this since 2023. Nebraska started in May, Montana and Arkansas in July. Those states are the preview, and the consistent finding across all of them is the same. The people who lose coverage are overwhelmingly not people refusing to work. They are people who were working and could not prove it in the format required, or whose notice went to an old address, or who did not know they had been flagged until the coverage was already gone. There is a 30-day window to provide proof of activity or of an exemption. 30 days is not long when the letter went to a house you moved out of. And I want to give you the specific mechanics because the difference between keeping coverage and losing it is almost entirely procedural. States are required to check automatically first using data they already hold. Payroll records, wage reporting, anything already flowing into a state system. For somebody with one steady employer and regular pay, that check usually succeeds and the person never hears about any of it. Where it breaks is everybody else, and everybody else is a large group. Somebody paid in cash, somebody working several small jobs, somebody self-employed, somebody doing seasonal work, somebody caring for a parent, which qualifies in many circumstances and appears in no payroll system anywhere in the country. Those are precisely the people who have to actively document and report, and precisely the people least likely to have a clean way of doing it. And there is a timing detail inside it that catches people who are otherwise fine. The requirement is monthly. So a person who works 50 hours a week for 8 months and nothing for 4 can fail in the 4, even though their annual total is far above what anybody would consider part-time. Construction, landscaping, agriculture, anything weather-dependent, anything tied to a season. The requirement does not average across a year, and it does not care that you worked double the standard in July. There are hardship provisions in some circumstances, and states have some flexibility in how they administer this, which is genuinely worth asking about rather than assuming. But the default is monthly, and the default is what most people will run into. One more thing, and it is the piece I would most want a family member to know. Being removed is not the end of it. There is an appeal, there is a reconsideration, and in most states, coverage can be restored once the documentation is provided. What is lost in the meantime is the meantime, and for somebody on a daily medication, the meantime is the whole problem. So the goal is never to get into that position, rather than to fight your way out of it, which is why every piece of practical advice in this section is about paperwork you assemble before anybody asks. Number 2 is on the same day, and it is the quieter half of the same provision. Renewals move from once a year to every 6 months for that same group. Twice as many opportunities in a year for a form to go astray, with exactly the same failure mode. And retroactive coverage shortens. That is the provision that let coverage reach backward to cover bills incurred shortly before you applied. Narrowing it means the gap between getting ill and getting approved becomes a gap somebody is responsible for, and that somebody is you. Number 3 is the consequence almost nobody has reported, and it is the one that concerns me most. Beginning the 1st of January, a person who loses or is denied Medicaid solely for failing the work requirement will not be eligible for marketplace subsidies either. Normally, losing Medicaid is precisely the event that qualifies you for help buying a plan. In this specific circumstance, it will not. So the safety net that usually sits underneath losing coverage does not catch this particular fall. If somebody in your family is in that category, that is worth knowing in December rather than in February. And I want to name who this actually reaches inside your own family, because a lot of people watching this are over 65 and are about to conclude none of it touches them. It reaches a daughter between jobs, a son-in-law doing seasonal work, a grandchild in their 20s working 2 part-time jobs, neither of which reports hours cleanly, a sibling caring for a spouse full-time, which is genuine work that no payroll system records. And it reaches something closer to home than that. A great many people in this audience are the person their family calls when a letter arrives that nobody understands. You may not be on this program, but you may very well be the one reading the form. So this section is not only for people it applies to, it is for the person in the family who ends up handling it. And in most families, that person is somebody over 65 with the time and the patience to sit on the phone. Carlis is 59 and he works, and he is exactly the person these states keep removing. He does maintenance and light construction for 3 different people, none of whom are a company with a payroll department. Some of it is paid by check and some of it is cash. In a good month, he is well past 80 hours. In February, he is not, because nobody in his part of the country builds anything in February. He is not avoiding work. He is doing the kind of work that does not produce the documents a portal wants. What he told me, and I have thought about it a great deal since, is that he has never once in his life been asked to prove he works. People who hire him know he works. That is the entire basis of the arrangement. He shows up, the thing gets fixed, he gets paid. The idea that he would need documentary evidence of it in a specific format, on a schedule, for a government portal, is not something the last 40 years of his working life prepared him for in any way. And that is the part I find genuinely difficult about this. Whatever anybody thinks of the policy, the people best equipped to satisfy a documentation requirement are people with salaried jobs, human resources departments, and regular pay stubs. Those people are also, overwhelmingly, not on this program. So the requirement is easiest to meet for the people least likely to face it, and hardest to meet for exactly the people it is aimed at. That is not an argument about whether somebody should work. It is an observation about who a form is built for. And the systems verify automatically where they can, by checking payroll records the state already holds. For somebody with one steady employer that works and no action is needed. For Carlis, there is nothing to check against, so the entire burden of proving a true thing falls on him every 6 months, on a 30-day clock. That is precisely what the guide is built for, knowing which document a system actually wants and keeping it before it is demanded, written plainly and in large type, so that being removed from coverage for a fortnight of bad weather does not turn into 3 months without a prescription. For somebody in Carlis's position, the cost of a failed renewal is not paperwork. It is the medication he takes daily. Same place, kevinexplains.shop. The link is in the description and in the pinned comment, and the code is on your screen if you are watching on the television. 7-day guarantee, every single time. A man who works, who cannot prove he works, on a 30-day clock every 6 months. There is one more thing about his situation that makes it harder than it looks from outside, and it is worth saying because it changes what help actually helps. The verification is not a single event. It is monthly reporting inside a 6-month renewal cycle, which means the paperwork is not something you handle once and forget. It is a recurring administrative job layered on top of the actual work. For somebody doing physical work in their late 50s, that is a real burden, and it is invisible in every discussion of the policy. The debate is always about whether people should work. Almost nobody is discussing whether the reporting system is buildable by the person required to use it. And that is the part I keep coming back to. Regardless of what anybody thinks of the underlying rule, a requirement is only as good as the mechanism for proving you met it. If the mechanism cannot see the work, the requirement is not measuring work. It is measuring paperwork. So if any of that touches your family, here is the practical instruction, and it has nothing to do with employment. Make sure the address, the phone number, and the email on file with the state Medicaid office are current. Today, not in December. And start keeping the record now rather than in January. A written log of dates and hours. Pay stubs kept rather than binned. A letter from whoever you help care for. Enrollment paperwork if it is school or training. That sounds excessive, and it is the difference between a portal accepting your documentation in an afternoon and a 30-day clock running while you try to reconstruct 6 months from memory. One more practical note on that, because it is the difference between a 5-minute problem and a 3-month one. If a notice arrives saying coverage is ending, respond the same week, even if you cannot assemble everything yet. A response that says the documentation is coming preserves your position in a way that silence does not. And ask specifically whether an exemption applies before arguing about hours. A great many people spend the 30-day window trying to prove work when they qualified for an exemption the whole time, and nobody mentioned it because the letter asks about hours and does not list the ways around the question. Caring for a dependent child, a disability, being medically frail. Those are not obscure edge cases, they are written into the rule, and the burden of raising them sits with you rather than with whoever sent the letter. Now the fourth thing that survived, and this one is not a cut, it is a benefit, and a great many people who qualify still have not claimed it. The senior deduction. If you are 65 or older, you can deduct an additional $6,000 from your taxable income, $12,000 for a couple where both qualify. It sits on top of your ordinary standard deduction and on top of the additional amount that has always existed for being over 65, and you get it whether you itemize or not. It is real, it delivered, and it is one of the few things from that law that put money directly into ordinary households. 2 things about it. It shrinks once your income passes $75,000 single or $150,000 married at 6 cents for every dollar above. And it is temporary, covering tax years 2025 through 2028, and then it is gone unless Congress acts. Here is why I am including it in a video about consequences. An enormous number of people who filed last year did not claim it because nobody told them it existed. If that is you, that is not lost. A return can be amended, and the difference comes back to you. And there is a cost side that nobody mentions. Reducing the tax collected on Social Security benefits also reduced the money flowing back into the trust fund. And this year's trustees report names that as one of the reasons the depletion date moved a quarter closer. So the same provision helped a lot of households this spring and moved a date on a calendar. Both of those are true, and anybody presenting only one of them is selling you something. And on that deduction, there is one more thing worth saying, because I get more questions about it than almost anything else. People keep asking whether it is the same as the extra amount they have always received for being over 65. It is not. That older one is smaller. It has been in the code for many years, and if you have been filing after 65, you have almost certainly been getting it without thinking about it. The new one is separate and sits on top. So a person over 65 now potentially has three layers: the ordinary standard deduction, the long-standing additional amount for being over 65, and then this new one on top of both. Hearing the phrase senior deduction, and assuming it is the one you already had, is the single most common reason this gets missed. It is also, not coincidentally, why so many returns were filed last year without it. Now let me tell you what did not come true, because it matters just as much and you deserve the correction. The mass hospital closures that were predicted have not materialized at the scale described. Rural hospitals remain under genuine financial pressure, and some have closed, which was true before this law and remains true now. But the collapse that was warned about in the summer of last year has not happened, and part of the reason is precisely the Medicare cut that was canceled. Your Social Security benefit was not cut. It has not been touched, and nothing in that law reduced anybody's monthly payment. And the Medicare Savings Program, which pays the Part B premium for people with limited income, still exists and is still available. I mention those three specifically because I still get emails from people who believe all three of them happened. Before I give you my read, there are three more things from that law worth knowing about, because they are landing now and almost nobody is covering them. The first is prescription drug plans. There has been a temporary subsidy holding standalone drug plan premiums down, and it is ending at the end of this year. The government's own figures are that around 75% of people on those plans will see an increase next year. Most of it lands in the range of $10 to $20 a month, and about a quarter of enrollees may see no increase at all. That is not catastrophic, and I am not going to dress it up as such. But if you have original Medicare with a supplement and a standalone drug plan, that is your section, and the window to change plans runs from the 15th of October to the 7th of December. The second is the out-of-pocket ceiling on prescription drugs. It rose from $2,000 to $2,100 this year and goes to $2,400 next year. That is a ceiling moving further away, meaning you spend more of your own money before the protection begins. For most people, it changes nothing because most people never approach it. For somebody on an expensive medication, it is $300 additional dollars, arriving early in the year. The third is the one I mentioned earlier, and it deserves a full sentence rather than a passing one. The reduction in tax collected on Social Security benefits was genuinely popular, and it helped a great many households. It also reduced money flowing back into the trust fund, and this year's trustees report lists that among the reasons the projected depletion date moved a quarter closer than last year's estimate. Nobody hid that. It was in the report. It simply did not travel, because a tax cut is a story, and an actuarial adjustment is not. And that is the third time in this video that the same thing has happened. The alarming version travels, the correction does not. The benefit travels, the cost does not. Which is not anybody's plot either. It is just what is interesting enough to repeat. So where do I come out on all of this, a year later? Not on the politics of the bill, because that is a genuine disagreement and it is not mine to settle for you. What strikes me is the sorting. Look at what survived and what did not, and it is almost perfectly explained by one thing. The Medicare provider cuts were reversed. Hospitals and physicians have organizations, lobbyists, and a permanent presence in Washington. The senior deduction survived because it is popular and visible, and politicians want credit for it. And the three provisions that land in January all share a characteristic. Each one falls on a single person filling out a form, alone, on a deadline, with no organization behind them. That is not a conspiracy, and it is not about which party wrote it. It is simply how a system responds to pressure. Pressure comes from organized groups. There is no lobby for the man doing maintenance work for 3 different households who has to prove his hours every 6 months. So the honest conclusion is uncomfortable, and I am going to say it plainly. The parts of that law that were going to hurt institutions got fixed. The parts that hurt individuals did not, and they arrive in January. Which is why the only defense available is knowing, in advance, what is actually coming rather than what was predicted a year ago. And there is one more observation from the year that I think is worth more than any single provision. Look at how you found out about each of these. The Medicare cut was covered enormously, for months, by everybody. The cancellation of it was covered by trade publications for hospital finance departments. The work requirement start date has been covered lightly. The marketplace subsidy exclusion has barely been covered at all, and it is arguably the most consequential item on the list for the specific person it hits. The coverage is almost perfectly inverse to how directly a thing affects an individual household. Big number, national scope, easy to describe, gets covered. Narrow, procedural, affects a specific person on a specific date, does not. Which means that if you rely on news to tell you what is coming, you will reliably be well informed about things that may not happen, and completely uninformed about things that definitely will. That is not a criticism of anybody doing the reporting. A story about a form has no audience. But it does mean the useful information is almost always the boring information, and nobody is going to bring it to you. So, 4 things. Most of them fit in one sitting. 1. If anybody in your household is on Medicaid through the expansion, update the address, phone, and email with the state agency this month, and start keeping a written record of work or qualifying activity now. 2. If somebody loses Medicaid over the work requirement, understand that marketplace subsidies will not be available in that circumstance. That changes what the fallback plan has to be. 3. If you are 65 or older, make sure the senior deduction is actually being claimed. If you missed it on a return you already filed, ask a professional about amending it because it is recoverable. 4. And this one is free. Stop acting on last year's warnings. The Medicare cut did not happen. Social Security was not reduced. The Medicare savings program still exists. If you have been delaying care or a decision on the strength of any of those, that reason expired months ago. And if you are looking at your own situation and cannot work out which of these actually applies to you, email me. The address is on your screen and in the description below. I read every one that comes in. Velma delayed a procedure for 5 months because the frightening version of the news reached her and the correction never did. Carlis works constantly and will spend January proving it to a portal that has no way to see the work he actually does. Neither of them was careless. One was misinformed by a warning that stopped being true, and one is about to be removed from coverage for succeeding at a job that does not generate paperwork. And that is really the whole of it. This is not a video asking you to take a side on a bill. It is asking you to know which of last year's warnings expired and which of them arrive in January, because those 2 lists are almost the opposite of what you were told. So spend a morning on the 4 things above. Update an address, keep a record, check a deduction, and let go of a fear that expired in November. That is the entire list, and every item on it is still open. I am Kevin. Thanks for watching. Do not forget to check the quiet rules at kevinexplains.shop.